Hey friends, Lucian here with the Bullish Bears team. This video is going to be about the different swing trading strategies that are out there. It's a beginner's video to help you get started. I'm going to show you some of the different strategies and then some key areas on where you would potentially buy and sell on stock charts using these different strategies. So, to begin, swing traders hold stocks or options between a few days up to a few months. So they're different than long-term traders that are holding, more long-term, several months on out up to maybe years. And they're also different than day traders that are selling stocks within the same day. So swing trading is kind of a broader category. It could be a few days. It could be technically if you hold a stock overnight into the next day, you can call yourself a swing trader. So it could be a couple days to a few days on up to, a few months. Typically, it's anywhere from a few days to a few weeks. So even a few months, again, it's subjective, but, anywhere less than I'd say a few months being in a trade. Now, you can swing trade both large caps and penny stocks. They're both popular to trade. Obviously, large cap stocks are going to be the safest due to the volatility of penny stocks. Again, not saying to not trade penny stocks or swing trade them, but be more careful holding them. Trading penny stocks are going to be safer, but swing trading them you can, again, as long as you get the proper entry and are willing to hold long term through the volatility swings. Now, you'll hear us talk about in our courses in our community all of the time about support and resistance levels, candlesticks, and patterns for entries and exits. The reason why we do that is because it's really essential to everything when it comes to trading. Fundamental analysis is very important, but remember, you still have to know where to buy and where to potentially sell, right? So the fundamentalists, the ones that do all the research on the companies, when they enter and exit a stock, they leave clues on stock charts. And those clues are patterns. And those are the areas, once you learn how to read candlesticks and patterns, those are the ways, those are showing you the key areas on where you potentially buy and where you potentially sell on a stock chart. Again, everything's a gauge. It helps you to give you the information you need. Nothing is foolproof when trading, but candlesticks are, we'd argue, the most important aspect of trading, and that's what's most important to learn, is learning how those patterns work. So with swing trading or just trading in general, you want to ideally enter on small candlesticks near support levels and then look to enter trades at reversal candlesticks or near resistance levels, and also at the break of trend line areas. So here's an example of a stock chart here. This is gold, a weekly chart. So I'm showing you, again, it's kind of subjective, and what to look for. Nothing's foolproof, and obviously these patterns have already played out. So it's easier sometimes to see the reversal patterns before the futures happened, because you can kind of target in on them. But as you look at this here, you can see I kind of highlighted some smaller candlesticks. Again, they're not perfect. I want to show you like resistance levels. When you see those little reversal candles as the stock's falling and then moving up, right? So you want to enter on those smaller candlesticks, not huge. You don't want to enter in on the big flag poles. You're looking to enter in on more of the flags, right? So nearer to support levels for buying and then selling nearer to those resistance levels. And obviously, when you're connecting those trend lines, you can see a lot of these smaller candlesticks, when they hit resistance, they show potential reversals back down to support levels. And then near support levels or at the base of trend lines, you can see smaller candlesticks for entries on the way up. So this is kind of a guide of just kind of giving you some examples of those smaller candlesticks, but you're looking to enter on those again, smaller flags or, base level candlestick reversal patterns, not entering in off of, flagpoles. Doesn't mean you can't enter in off flagpoles, but you just have to remember you're risking a lot more because those flagpoles are much bigger than those flags or smaller candlesticks. And you'll notice in this photo here, When those flags or those channels that I'm showing on the charts, you'll see when price starts to move out of those channels a lot of times, many times it ends up falling. Typically, when price falls out of those channels, it usually does end up falling. A lot of times it'll still go up, but you'll notice just kind of in those three examples right there, that second one, first and second one, it kind of traded sideways a bit before it ended up failing. But you'll notice it basically creates a double top when that happens a lot of times. So it could fall out of the channel, go back up for a little retest up back to the highs before it fails. And then you have a lot in that double top failure. So you'll see again, when price starts to fail those lower trend line channels, you have to be careful. Those are big warning signs to potentially exit your trade. So you're entering in on those small candlesticks, you're exiting at or near resistance with those small candlesticks at resistance levels, or when it starts to break that lower trend line area. Now with swing trading, looking at multiple chart time frames is key. So again, it all depends what your, I guess you'd say how long you're going for swing trading. If you're only going to be swing trading for a couple days, 2 or 3 days, then probably the hourly and the daily charts are going to be mainly what you're looking for. If you're looking to go out for a couple weeks or more, up to a few months, then you're going to be looking more at the monthly and weekly charts. It's still a good idea to get a good gauge on most of the major time frames, daily, weekly, monthly charts, so you can see where price is bouncing near support levels, and also when it might be broaching critical resistance levels. It's also very important to look at a 1 hour chart for more of a shorter term trend. So if you're doing more shorter term, few days, a week to 2 weeks out, to be in a trade, if that's kind of your time frame, that hourly chart is very important. And then you're looking at those 5-minute charts as well for those pullbacks and entries. So you want to ideally get a good entry near support level. So you could get into a trade and it's going to be good for a swing trade. But if you get a bad entry, not looking for pullbacks on those intraday shorter time frames, those 5-minute charts, and then looking for your entries on a 1 minute to get your best entry possible, that's where it could cause some pain, especially when you're in an options contract if you don't get a good entry. So it's important, again, to look at all the different charts, map out support and resistance levels so you get a good gauge on where to enter a trade. So here's an example of some channels I drew on Facebook. I'm going to show you a few different charts on it, the different time frames, but you can see that channel, that kind of megaphone pattern on the weekly chart, and you'll see kind of how it extends down into the monthly. Those lines that I did on the weekly, you can see how it moved down into a monthly chart. So this gives you a good kind of snapshot at where price is. Currently, price is at a very important support level. So that's overall on those longer term trends, but then you got to zoom in to kind of the shorter term trends and see what's happening on the shorter term charts. So when you zoom in, on the weekly and monthly, it could look pretty good, but then when you start to zoom in into the daily and hourly, you can see, okay, it's a little bit risky here. Price is really showing some bearishness right near those support levels. You're not seeing at the moment any small candlestick hold. You'd like to see, if you're bullish here, a smaller, hammer or doji, something really solid bullish hammer, bullish hold on this area to continue up. So you see why it's important to also drill down to the shorter time frames, such as the daily and the hourly, so you can look and see what is that short-term trend doing overall, because you obviously want to get in a good entry. So something might be good long term, but if you bought an options contract, let's say right here, and the thing dropped for a few days or a week, it could put you in a lot of pain in that position before it ends up reversing and going your way. So that's why entries are super important, and that's why looking at multiple time frames when swing trading and all trading in general is key. So you'll hear us talking about this all the time, candlestick patterns and how important they are. They are the most important indicator to use when trading. They form the basis of the bigger overall patterns, and those patterns turn into the areas where you're able to draw trend lines, right? You need to have something to draw trend lines on, and that's what candlesticks form. They form those peaks and valleys to be able to do those, bigger overall trend lines, and it shows also more of those shorter term patterns, reversal patterns. Patterns are key when trading because that's how traders make their educated trading decisions. And again, also very important to look at reversal areas for entries and exits. If you need more help with candlesticks, we have our free candlesticks ebook and wallpaper backgrounds. You can download that under our courses section. So we have a great ebook that shows all the different major patterns, where to enter, where to put your stop losses. And then we have custom made desktop backgrounds, which would be great to put on your computer or print out so you can see all of the different major candlestick patterns. And that's what you need to do, is just study, give it some time, let those patterns seep into your subconscious, so when you're trading, they become more and more familiar over time as you start to look at hundreds and thousands of charts. And when you see those candlestick patterns and how they come together, that's what helps you to get those good entries and exits when trading. So here's an example of a double top pattern on a weekly chart. This is a huge warning sign of a reversal, a bearish reversal. You can see price moves up, makes that top, that all-time high. What does price do? It retraces back down. It gets a bounce, retraces down, retraces then back up, and it creates a lower high. And when you see those two lower highs like that, that's not a good sign. That's a very bearish sign. And you can see that second highlight on the chart was a warning, and look, price dropped pretty hard after that, and now it's at a really critical support level, that neckline of that double top. If price fails here, it could have a pretty far drop down potentially. So candlesticks, again, you have to pay attention to them. They're not foolproof. They do fail at times, but most of all, when you see these major patterns, 60-70% of the time they end up going the direction that it's warning. So other times it won't, but that's why you have to have proper risk management and keep those losses small for when the pattern reverses and goes against you. So if you were swing trading a setup like this on that second highlighted candle, you wouldn't have gone long there. You would have looked to take a potential short position or buying, options. So you could, again, buy stocks, not on, shorting SPY, but like you can go buying puts on SPY. But if that was like Facebook or Apple or something like that, or another stock, just pretending that's ABC company, whatever it is, you could go short shares when you see stuff like that. You got to be careful shorting long term, right? We are very cautious on telling people to go short swing trading. But, if it's a pop or an overnight, kind of intraday, it's a little less risky. But, this is where you would look to do those bearish option strategies when you see that reversal on that, or that double top, right? So you wouldn't necessarily be going long on a swing trade. You would look to be taking a short, and then you would be looking to go long when those support levels hold again. Now, moving average lines are very popular lines that show important support and resistance levels. So they form, again, candlesticks are the more immediate price action, that they're immediately what's happening on a chart. Moving average lines are lagging indicators that form, but they're very popular because they show really important support and resistance levels. So you'll see many of times price action will reverse near those levels. So you'll see many times they'll hold as support levels, and then other times it hits in the reversed near there at resistance. So they show very important support and resistance levels. Again, they are not foolproof, but they're very popular, and they can be very helpful when trading. So simple moving average lines and exponential moving average lines are the what people use on charts. If you're using simple moving average lines, the most popular simple moving average lines are the 50, 100, and 200. They're also known as SMAs. So the most popular SMAs are the 50, 100, and 200. And then exponential moving average lines, those are more of the shorter term, moving average lines. The most popular EMAs, or exponential moving average lines, are the 9 and the 20 EMA together, or the 13. The 13 is kind of the middle between the 9 and the 20, so you don't need to use all three. You could either use the 9 and the 20 together, or the 13 EMA in and of itself. So here's an example of a stock chart here with Facebook, and you'll see I added the moving average lines onto the chart. It's those lines that are underneath the candlesticks, and you can see how I put those on my chart to the left, and I have them highlighted there. You can see the 9 and the 20 EMAs, as well as the 50, 100, and 200 simple moving average lines. And like I said, when you start to see and you pay attention here, you'll see as price, again, price is like rubber bands, right? When price gets overextended in either direction, it naturally wants to gravitate back to those equilibrium levels. And many times it happens near those important support and resistance levels, those moving average lines, right? So you'll see as price gets far away, see how it kind of gravitates back in and many times bounces off of those moving average lines. When it holds those 9 and 20 levels, that's more of that shorter term kind of trend, but you'll see a lot of times it ends up falling and it goes back to those simple moving average lines, those longer moving average line times, and that's where you can see those are very important. You know, that especially that 200 SMA. You know, if price gets far away, when price moves back down to that black line, that 200 SMA, if you're bullish on a stock, you want to see it hold, you know, so you'll see many times reversals happen near that area. So on all of those moving average lines, you know, again, those shorter term trends with the exponential moving average lines, and then you have those simple moving average lines, which is more of those longer term trends. So again, pay attention to those moving average lines. Very, very popular and very helpful when swing trading. So let's talk about a few popular swing trading strategies. The Ride the 9 EMA is a nicer shorter term trend or swing trading strategy. What you're looking to do on this strategy is enter on a small pullback hold of the 9 EMA, and then you exit when you get a half a candlestick or more close below the 9 EMA. You could use the 13 EMA instead. So if you don't use the 9 and the 20 and you use the 13, you can use the Ride the 9, or you could use the Ride the 13 strategy. So here's how the Ride the 9 strategy works. You can see I kind of showed a little, that blue line right there is the 9 EMA. You can see that kind of that hammer hold right near off that 9 EMA. So you can exit on the breakout of that hammer, which is basically like a flag when price went up and kind of consolidated back. You can enter in on a break of that kind of hammer, use a candlestick close below that as your stop level, and then you could ride that 9 EMA up until you see the exit, right where it says exit. You see how there's a candle close below that 9 EMA? That's where you would absolutely get out, right? So that's a, you know, on SPY, that's moving up from, let's say, 323 up to that 340 level, right? So that's a $17 move. There's other areas you can exit as well. You can exit as price is further away, depending on when you want to take your profits. We always recommend taking your profits along the way. But for the Ride the 9 strategy, you could just ride that 9 EMA, get in off that 9 EMA, get out when price closes half or more of a candlestick close below the 9 EMA. There was a warning candle below that bigger, above, before that exit candle, that bigger one before. You could have entered there, even though it was only like a quarter of the candlestick. It's still a warning, but you would have absolutely exited on that trade once it fell, you know, on that second candlestick. But again, that's the Ride the 9. You could use that as that kind of shorter term trading strategy. So you hear the term trend trading, or you also hear the trend is your friend. That's where it's, again, when you're trading, finding the trend is super important. You want to know if there's a trend up or a trend down. You can trade making money when you can make money when the market is trading sideways. That's, you know, there's option strategies for that. But if you're doing this swing trading, you know, strategy and you want to find a direction up or down, this is where you want to find that and confirmed that overall trend. And that's where you're looking to connect at least 2 to 3 peaks and valleys on a chart, right? Those are what create support and resistance levels, and they turn into those megaphone or wedge patterns. So when you're finding those bases, those base levels, and those peak levels, what you're looking to do is look for long or short entries near those angular support and resistance levels. So you look for long entries at angular support levels, those smaller candlesticks, and then you look for entries or exits at those angular support or angular resistance levels, or that's where you're looking to take your short or bearish position. So if you're going long, you're buying at those angular support levels. If you're going short, you're shorting near those angular resistance levels, and you look for those reversal candlesticks near those, again, those support and resistance levels. And you look to exit your trade. If you're going long, you exit near those resistance levels on angular resistance or the break of those trend lines. So here's an example of where you would go long and short. You see how that creates those falling wedges and those kind of rising wedges, rising channels. So you find those channels, and as you can see, as the price is falling on that first one, it's creating that short position. You could take a short after it's hitting that resistance, and then you cover, or you could go long as price hits those support levels. Those are a little bit bigger candlesticks. Again, you'd like to have smaller ones, but this is also a chart of the SPY as well. Sometimes you don't always get small candlesticks. This is where you have to manage your risk and also look at what patterns are forming it overall. You can see this is a reversal of a falling wedge or a breakout of a falling wedge. So that is a nice, nice reversal pattern. So you could look to get in at the base of that falling wedge, or you could let that breakout happen and then look for that retest to happen. Again, that was kind of not the greatest candlestick, but sometimes, again, candlesticks are not perfect. You don't always get the best shot at them, but you'll see there's that retest. So it broke out of the falling wedge, retested. You could have gone long there. And then near the top of that channel, as you start to see those reversal candlesticks near resistance, that's where you would look to either short, go short, or take profits on your long positions. And as you can see, kind of connect as many of those peaks and valleys as possible, right? So you see when you connect those peaks and valleys, they form those trend lines, and then they form those bigger overall megaphone and rising channels. Dip buying, another very popular strategy. This is where you watch for a stock to sell off. So if a stock is really selling off, you look for reversal candles, or you look for a stock that's just pulling back. So a stock that's falling really hard for a reversal up, or a stock that's pulling back. So it may have popped up, now it's coming back to those support levels. Many times this happens near those moving average lines or at the base of trend lines. So what you want to do is look for reversal candlesticks such as hammers, dojis, spinning tops. That's confirming that that support level is holding. And then you ideally want to risk off of small reversal candlesticks. So let's take a look at this chart, GLD. You can see those little candlesticks that I put buy next to. Those are smaller candlesticks, as you see, as price is kind of falling to those support levels, right? So it kind of moves up, comes back down, holds, moves up, comes back down, holds, up, down, and then you can see those small little candlesticks. Those are the small candlesticks you ideally want to risk off of. Again, you want to risk off flags, those small little reversals, not big flag pulls, because the bigger the candlestick, the bigger the risk. So that's something to look for, those little, kind of those smaller reversal candlesticks. And you see many a times those hold and then either break out or get a small move back up. And then that's where you connect those trend lines as well. So you can find those channels, get in near those support small candlestick areas, and then find those resistance areas above. Here's an example of the same stock chart of GLD, and this time what I did was just added on the moving average lines, right? So you see how near this happens a lot of times, those reversals or those holds or the dip buys, they happen right near those important moving average lines, right? So the moving average lines are not perfect, but you'll see many times they give you great warnings of reversals, either to the reversal to the upside or reversal to the downside. So again, moving average lines can be very, very useful when swing trading. So these are some of the basic strategies, again, to swing trading. There's so many different strategies that are out there, but we do teach how to swing trade in our community. It is a great place to learn. We show real time the goods and the bads. We show, again, large cap, small cap stocks. We teach different, both, stocks and options. So how you would do, swing trading with both stocks as well as options. So our trade room's a great place to learn. You can come in, ask questions. You can talk to our mods, ask questions of our mods, interact with other community members. And then we can't stress it enough, practice what we teach you, right? So practice learning in our trade rooms. Also, a great way to practice is we have real-time swing trade alerts. We have options alerts. So it's a great place where you can take your virtual account when we send out a real-time options alert. Practice if you're brand new in a virtual account. Don't trade it with real money until you're comfortable and you know what you're doing. The best way to do it is open up a virtual account, take our real-time alerts. When we call them out, practice them in a virtual account until you get comfortable swing trading, right? That's simple. So again, we have so much to offer in our community. If you're not a member yet, we'd greatly love to have you. If you are a member, we thank you for being a member, and we hope we're helping you in our community. So again, hopefully this video helped you on swing trading, and we will see you in our community. Enjoy.